So, Treasury Management. Next. What is Treasury Management? Treasury generally refers to the funds and revenue at the disposal of the bank and day-to-day management of the same. The Treasury acts as the custodian of cash and other liquid assets. The art of managing within the acceptable level of risk the consolidated fund of the bank optimally and profitably is called treasury management. And last is it is the window through which banks raise funds or place funds for its operations. Next, introduction. Traditionally, the role of treasury in banks was limited to ensuring the maintenance of RBI stipulated norms, which is CRR or cash reserve ratio and SLR or statutory liquidity ratio. Second is activity in foreign exchange was confined to meeting merchants and customers' requirements for imports, exports, remittances, and deposit. The Treasury Department is responsible for a company's liquidity. The treasurer must monitor current and projected cash flows and special funding needs and use this information to correctly invest excess fund as well as be prepared for additional borrowings or capital raises. Second is the department must also safeguard existing assets, which calls for the prudent investment of funds while guarding against excessive losses on interest rates and foreign exchange positions. And the treasurer needs to monitor the internal processes and decisions that cause changes in working capital and profitability while also maintaining key relationships with investors and lenders. Next. So, role of treasury management, cash forecasting, working capital management, cash management, investment management, treasury risk management, management advice, credit rating agency relation, bank relationships, funding raising, credit granting, and other activities. Next. So, the cash forecasting, the accounting staff generally handles the receipt and disbursement of cash, but the treasury staff needs to compile this information from all subsidiaries into short-range and long-range cash forecasts. Next is working capital management. A key component of cash forecasting and cash availability is working capital, which involves changes in the levels of the current assets and current liabilities in response to a company's general level of sales and various internal policies. And cash management. The treasury staff uses the information it obtained from its cash forecasting and working capital management activities to ensure that sufficient cash is available for operational needs. Next is investment management. The treasury staff is responsible for the proper investment of excess funds. Next is treasury risk management. The interest rates that a company pays on its debt obligations may vary directly with market rates, which present a problem if market rates are rising. Next is management advice. The Treasury staff monitors market conditions constantly, therefore, is an excellent in-house resource for the management team should they want to know about interest rates that the company is likely to pay on new debt offerings. The availability of debt probable terms of equity investors will want in exchange for their investment of the company. Next. Credit rating agency relations. When a company issues marketable debt, It is likely the credit rating agency will review the company's financial conditions and assign a credit rating to the debt. Bank relationships. A long-term and open relationship can lead to some degree of bank cooperation if a company is having financial difficulties and may sometimes lead to modest reductions in bank fees. Fundraising. A key function is for the Treasury to maintain excellent relation with the investment community for fundraising purposes. Next. So credit granting. The granting of credit to customers can lie within the purview of the Treasury Department or may be handed off to the accounting staff. And last, other activities. If a company engages in mergers and acquisitions on a regular basis, then the Treasury staff should have expertise in integrating the Treasury system of acquirers into those of the company. Next.
Objectives of Treasury Management: to take advantage of the attractive trading and arbitrage opportunities in the bond and forex markets, to deploy and invest the deposit liabilities internal generation and cash flows from maturing assets for maximum return on a current and forward basis consistent with the bank's risk policies appetite. To fund the balance sheet on current and forward basis as cheaply as possible, taking into account the marginal impact of these actions. To effectively manage the forex assets and liabilities of the bank. To manage and contain the treasury risk of the bank within the approved and prudential norms of the bank and regulatory authorities. To assess, advise, and manage the financial risk associated with the non-treasury assets and liabilities of the bank, to adopt the best practices in dealing, clearing, settlement, and risk management in treasury operations, to maintain statutory reserve, CRR and SLR as mandated by RBI on current and forward planning basis, to deploy profitably and without comparing liquidity, the clearing surpluses of the bank, to identify and borrow the best terms from the market to meet the clearing deficits of the bank, to offer comprehensive value-added treasury and related services to the bank's customers, and lastly, to act as a profit center of the bank. So the next one is organizational structure. It should facilitate the handling of all market operations from dealing to settlement, custody, and accounting in both the domestic and foreign exchange markets. As follows: front office dealing risk taking, mid office risk management and management information, back office confirmation, settlement, accounting, and reconciliation. Structure of integrated treasury: the Treasury Department is manned by the front office, mid-office, bank office, and the audit group. In some cases, the audit group forms a part of the middle office only. The dealers-traders constitute the front office. In the course of their buying and selling transactions, they are the first point of interface with the other participants in the market, dealers of the other banks, brokers, and customers. They report to their department heads. They also interact amongst themselves to exploit arbitrage opportunities. A mid-office setup, independent of the Treasury unit, responsible for risk monitoring, measurement analysis, and reports directly to the top management for control. This unit provides risk assessment to Asset Liability Committee or ALCO and is responsible for daily tracking of risk exposures individually as well as collectively. The back office undertakes accounting, settlement, and reconciliation operations. The audit group independently audits daily operations and the Treasury Department to ensure adherence to internal regulatory system procedures. So, here's the structure of an integrated treasury. So, top management, audit head, risk management, audit group, treasury head, mid office, and etc. So, advantages of integrating treasury operation is to improve portfolio profitability, risk insulation, and also to synergize banking assets with trading assets. This is achieved through efficient utilization of funds, cost-effective sourcing of liability, proper transfer pricing, exchange of information between the money and forex dealers, single window service to customers, effective MIS, improved internal control, minimization of risk, and better regulatory compliance. An integrated treasury act as a center of arbitrage and hedging activities. And last is it seeks to maximize its currency portfolio and free transfer of funds from one currency to another so as to remain a proactive profit center.
Basic treasury functions, domestic operations, maintenance, statutory reserves, managing liquidity, profitability, deployment of reserves, trading and arbitrate, hedge and cover operations, mid-back, office functions, forex operations, extending cover foreign exchange trade transactions, funding and managing forex assets and liabilities, providing hedge to forex risk, propriety and for its constituents, trading and arbitrage, mid-back office function, responsibilities of a treasurer, general financial oversight, funding, fundraising and sales, financial planning and budgeting, financial reporting, banking, bookkeeping and record keeping, control of fixed assets and stocks, general financial oversight. First is to oversee and present budgets, accounts, and financial statements to the management committee. Raise with designated staff about financial matters. Ensure compliance with relevant legislation. Ensure that appropriate financial systems and controls are in place. Financial planning and budgeting. First is to prepare and present budgets for new or ongoing work. Advice on financial implications of strategic and operational plans. Present revised financial forecasts based on actual spend. Financial reporting. First is to present regular reports on the organization's financial position. Second, present accounts at AGM. Banking bookkeeping and record keeping. Manage bank account. Set up appropriate system for bookkeeping, payments, logments, and petty cash. Ensure everyone handling money keeps proper records and documentation. Control of fixed assets and stock. First is to ensure proper records and keep. Second, ensure required insurance are in place. Risk management. One of the major responsibilities is to manage the risks arising out of the financial transactions entered into by Treasury. It has to manage the liquidity risk and price risk in addition to the counterparty risk and issuer risk. There should be a well-defined contingency liquidity plan. Term structure for interest rates are limit, maximum, cumulative overflow limits, factor sensitivities, etc. Thank you.